It's 2 o'clock on the dot Central Time. We're going to go ahead and get started. This is Rebecca with Results here with Texas Homeowners Helpline, and I am hosting today's call with iConnect Texas. And iConnect Texas, as you know, we are a community initiative that brings workshops, resources to the community, and we would like to basically join the community and make sure that we stay connected, especially during this time when we are all staying at home safe. So today's special guest is Wade Betz. Winning with Wade is what his name is. And so ever since I met Wade, we had a connection because we both have, taglines for our names. I'm Rebecca with Results. He's Winning with Wade. So we really kicked it off when we first met about a year or so ago. And for those of you that don't know Wade, he is with Nexa Mortgage. He has been a loan officer for at least over a decade. Is that right, Wade?
Yep, 14 years.
14 years. So just almost as long as well as that I've been in real estate. And so we hope to bring you some information that you may have not heard yet regarding mortgages, the interest rates, what is going on with the new regulations with the mortgages because of the pandemic. And then also really important, whether you are in the industry trying to help your clients or you are yourself looking for information on mortgages and how to get relief, we are going to actually be going over that information as well. So without further ado, I'd like to also thank Angelica Buenteo with Texas Homeowners Helpline. She's joining us today. She's going to be doing the question and answers. So if you do have questions, make sure you write them down and she'll be going over them with us. So Wade, welcome and tell us a little bit about yourself.
So I am born and raised in New Orleans personally, have a wife and 2 boys. And today, believe it or not, is my wife's and I's 21-year dating anniversary. So it's when we had our very first date and I took her to Chili's. So I was a big spender back when I was in my 20s. Exactly. But today's always a special day for us. So normally we would actually go out to Chili's for dinner tonight, but that's not possible. And let's be honest, there's plenty of better places than Chili's. So we're going to have a family night tonight, but that's personally. Professionally, I've been in the mortgage industry for 14 years. I've helped thousands of families build wealth and memories with real estate. It's my passion. Honestly, having gone through the last mortgage economic collapse and going through what's happening right now, it's definitely prepared me, but it's different. And we're going to get into some specifics, but the analogy that I like to use with my clients is that I'm your airplane captain and I promise to land you safely in your new home. I can't promise that we're not going to run into some turbulence. And as a matter of fact, these days, you're going to run into some turbulence because everything is tightening up. And frankly, the goalposts keep getting moved on us mid-process because everything is tightening up by the day. So the analogy is, I'll still land you safely, but the expectations I'm able to set for you in the beginning might not be how it ends up. So I'm just asking for flexibility, whether it's with myself or with the lender that you're partnering with. Just be flexible and know that we're in unprecedented times and to cut them a break because they're literally doing the best that they can to navigate the market that we're in. Okay.
And that makes a lot of sense, Wade, because we actually, one of the reasons we thought about doing this webinar is because we had a transaction about a week and a half, 2 weeks ago that, almost went south on us because of the new regulations. And that's, what prompted this conversation of, what the heck is going on in the mortgage industry? How do we as, professionals, as far as being realtors, how do we prepare our clients? How do we get the information across also, in a timely fashion because things are changing by the minute. So with that said, I'll go ahead and turn it back over to Wade. And maybe Wade, if you can give us a kind of a general update as far as the mortgage industry, what has happened in the last couple of weeks and why are we keep referencing that it keeps changing and quite frankly, potentially could keep changing as we go along in the weeks here?
So I'll try not to get too technical, and I'll do a screen share here in just a bit where I show you some information. But the gist of it is, I already referenced the 2008 economic collapse. that was largely driven by my profession. The housing industry, the mortgage industry, with their loose lending guidelines and subprime products, caused that to no short terms. This time around, though, it's different. The homeowners have record equity in their property. Underwriting on files was very strong the last several years, so you always had to have the ability to repay the loan. So they're very well underwritten. But what happened when COVID came onto the scene, it was a lot of the law of unintended consequences. So not to talk political affiliations, but the policies that are coming out that the Federal Reserve specifically is pushing has caused some unintended consequences. And what I mean by that, there's two main things here. For one, they came out and said that forbearance is an option. Now, the point I want to drive home here about your mortgage payment is, despite what I tell you on this webinar, if you have questions about making your payment or anything along those lines, you absolutely must pick up the phone and contact your servicer. Whoever you make your mortgage payment to, you have to communicate. Do not, under any circumstances, just stop making your payment because the news said that you could, okay? I need to make sure that we're clear on that. Now, the forbearance word that you keep hearing, that sounds good on the surface, but there's a lot that goes into that, and it has me very worried personally. So forbearance, the definition of that is essentially the government says you can miss up to 12 payments, but after the first 3, it gets basically re-reviewed. So you can do this with no proof of hardship at all. You can just call up your servicer and it will be granted. But what you need to understand is that forbearance is not the same as deferment, okay, or forgiveness. So if your mortgage payment is $1,000 a month, just for simple math, and you skip those 3 payments, that 4th month, you owe $4,000. It's a lump sum, it's a balloon note. It does not get tacked on to the end of the loan. And my personal fear is that you have a lot of people that signed up for forbearance because they thought it would let them get back on their feet. But when they get to the end of that, they're going to be in some serious trouble. So definitely have candid conversations with your servicer about what you can and can't do. If you can make your mortgage payment, I would encourage you to do so. If you cannot, you need to pick up the phone and have a conversation. It's a big deal because servicers still owe the money that you're supposed to pay them to the bond investors that they've sold the mortgage to. So unless your mortgage is a portfolio loan where that banking institution lent you their own money, which is a very, very small sliver of the market, if that's not the case, your mortgage is owned by somebody else other than your servicer, and the servicer still owes them your money. And it has the writing is on the wall. The Federal Reserve did not set up a liquidity facility to help servicers cover the gaps. So they essentially said, hey, anyone who wants to can miss a payment. What's up, Rebecca?
So I'm going to give you a quick timeout because as far as the terms that we're using, because I want to make sure, I want to make sure that everybody is on the same page, because I know my fellow professionals in the industry, we're on the same page. We get what you're saying about with servicers and liquidity and all these, other words that we're using that are technical, to some people that may be sitting at home going, what is he saying? So
fair enough.
So let me back up a little bit here and explain just really quickly, what is a servicer, what that means, and kind of break it down to how that would affect somebody who is potentially looking at, doing a forbearance or something. So the way that it works is when you get a loan, they more than likely, like Wade said, usually sell that off to somebody who actually owns your note, owns the loan, okay? Mm-hmm. So that's the person who actually makes the money on the interest that you pay. So what happens is you may have a servicer, let's say, I don't know, I'm just gonna throw a name, ABC Mortgage Company, okay? So ABC Mortgage Company may or may not be the one who actually owns your note, so the lender, okay? So what they do is they hire ABC Mortgage Company to basically be the paper person. They're the ones who send your bill out. They're the ones who collect your payment. They're the ones who, calculate your interest and your taxes and make sure you have enough in your quote unquote escrow account to pay those at the end of the year. So what Wade is explaining is that your servicer still has those payments due to the lender, to the person who's actually receiving the money and receiving your interest payments, okay?
Right.
And so this is really where a lot of folks, have a misstep because they think, oh, well, my comadre, my friend, my brother has ABC Mortgage Company just like I do. They were able to get, XYZ help, right? Maybe they were able to skip 2 payments and it is going to be actually forgiven or something like that. Where maybe your loan may be actually owned by somebody, a lender completely different, but they're still using ABC Mortgage Company to send you your bills. Okay, so just because ABC Mortgage Company is in the top of that bill that you get every month doesn't mean that they own it. Okay, that's what Wade is meaning by servicing company versus your lender. Okay, and this is really important because as we go along here and explain this a little bit better, there's actually some programs through Fannie Mae, Freddie Mac that are government, backed loans that have a little bit more options than maybe some loans that are not. Okay, and so that's why that's important. So sorry, Wade, I just had to give that quick time out so that we're all on the same page and everybody is moving forward together.
Yeah, so that's a great point. So the servicer is the key. Who you make your mortgage payment to is exactly who you need to be communicating all of these questions with. So again, we're just talking general terms here, your specific situation, you need to talk to your servicer. Now, so as Rebecca was saying, the servicer still owes the owner, the investor in your mortgage note, they still owe those payments to them, regardless of whether you pay or not. So in a normal market with normal default rates, that's no big deal. They can handle the handful of clients that are going through that. But when you're having, I think Mr. Cooper, the biggest servicer in the country, non-bank servicer, I think the first week this was an option, they took like 86,000 calls for forbearance requests. I mean, we're talking tens and tens, if not hundreds of thousands of people across the country asking to miss 3 payments, and there's no proof of hardship, but that is going to sink the servicing sector. And the government did not have the foresight, or nor did they agree to set up a liquidity facility to allow servicers to survive, frankly. So there's going to be a shuffling of servicing rights in the industry as some servicers don't make it because of what's happening. And honestly, through no fault of their own. They're required by federal law to allow people to go in forbearance with basically no questions asked, although you should be asking questions. But that's going to sink a lot of companies, frankly, unless something changes. So that's one law of unintended consequences. Another thing that the Fed has done is they said that they're going to buy unlimited mortgage-backed securities. Okay, so the mortgage-backed securities market is essentially the mortgage bond market. And that is the benchmark that actually sets interest rates for lenders. All right, so by the Federal Reserve saying they're going to buy unlimited quantities of those, the cost of those is causing interest rates to drop, or it should be causing interest rates to drop. Now, here's the weird part with the market where we're in. So the mortgage industry as a whole only has the capacity to handle about 1.5 trillion of refinance transactions every year. And with what the Fed is doing, and I've heard different estimates, there's anywhere from $5 to $6 trillion worth of loans that could be refinanced, that want to be refinanced in the next 2 to 3 months. And the industry just doesn't have the capacity to handle that. So it's certainly a good problem to have, especially for me personally, but it's still a problem because some lenders, and this sounds very strange to say out loud, some lenders cannot handle any more business, and they've raised their rates up to stop the flow of applications coming in the door. And I've seen some lenders that price purchase transactions differently than refinances. So it's a very bizarre market right now because interest rates in theory should be lower than they are. And don't get me wrong, they're still very, very attractive.
Sure.
But they're not where they could be because lenders do not have the capacity to handle that. And then you throw in a global pandemic where everyone's working remotely, and it just makes the problem even worse. Yes. So that is the Fed, what they're doing. It sounds great in the headline of the press, but behind the scenes, it's actually causing significant operational issues. Mm-hmm. And I don't want to get too much in the weeds here, but the fact is, if they're pushing rates artificially low, there's a hedging cost that every lender pays, essentially an insurance company, to hedge the exposure of their locked pipeline. So when you lock a loan with the lender, they don't turn around and lock it with the investor. They go out and buy a hedging insurance policy to protect themselves so that they know they can deliver that rate, and it minimizes their exposure. So that's simplistic terms. The fact, though, with the Fed pushing rates lower, it's blowing up their hedging cost. And you had some very large lenders get 7- and 8-figure margin calls. We're talking huge sums of money that they need to come up with in a very short period of time. And you almost had people go out of business overnight. And again, it was unintended consequences of the Fed. You think they're doing good, but it's really put the mortgage industry on its heels. And a lot of companies now are having to tighten the credit box because everything is so volatile with people losing jobs at record paces. As a matter of fact, Rebecca, I'm going to share my screen, and I have a little video I want to show you so that you can see exactly what I'm talking about here.
Sure. So while you do that, Wade, I just want to say, it's really important, and I thank you again for bringing this up, because this is something that a lot of folks aren't talking about. We're not talking about why, everybody wants to know, what are the rates, right? Well, they dropped, they're climbing, they're lower, they're higher, but really understanding the reason why that's happening is really important. So right. It looks like you have it up here. So go ahead, I'll let you take back over.
Yeah, sorry about that. So this is the initial jobless claims since they began tracking this. And so, I mean, it's just a 30-second clip, but you can see it's all over the board over time. And then as we get closer and closer, it spikes up, and then it goes way down, and then wait for it. Boom.
Oh.
That is what our country is dealing with right now. And it's a big problem.
Yeah.
So it's causing massive, massive changes to underwriting guidelines on a regular basis. Mm-hmm. Things that we've never had to deal with before. And one of the more recent changes has been day of funding verification of employment, which historically that's been allowed to be done within 10 days of closing, which makes the closing process very smooth for the most part. But when you're talking about having to do it the day of funding, it's causing some issues. And again, every company in America does it different. And remember, all of those companies are all working remotely as well. So it's become very, very challenging to navigate this. And it's unfortunate, but it's the reality of the situation. Now, a lot of people are thinking to themselves, is this going to lead to a housing collapse? And I don't think it's going to have that type of effect because of this reason right here. Okay? So 53.8% of Americans have at least 50% equity in their homes. 37% of Americans own their home completely free and clear. And then of the homes that have mortgages on it, 26.7% have at least 50% equity. So Americans are sitting on record home equity. Now, don't get me wrong, there's probably going to be an uptick in home sales because, frankly, people are going to have to sell because of the economic situation that COVID put them in. Mm-hmm. But I just don't see a significant amount of short sales or foreclosures. Yes, there's going to be an uptick, but I don't expect a flood because people have equity. The last time that we were doing this and the mortgage market was imploding, that everyone was doing 100% financing. You were upside down on your home from day one. And this always makes me chuckle. This is kind of what we're dealing with right now. So back in 2008, we were not viewed very kindly in the world, but now it's different. Now we have the ability to help people. We're refinancing people at record numbers, at record low interest rates to free up money for their budget. We're allowing people to tap the equity in their home to pay off other much higher consumer debt. I expect that to pick up as people take on debt to survive during these tough times. But they have, by and large, equity in their home. And I know Texas is more restrictive on what we're allowed to do with that equity, but that's where a professional mortgage advisor would come in and kind of lay out the roadmap for how it's best to use those funds to accomplish your long and short-term financial goals. But using your home equity with rates, in the threes, I'll just say that general statement, it's a lot better than paying high interest credit card debt in the 20s or teens or auto loans. You get what I'm saying. We're helping a lot of people pay off a lot of debt so that way they can improve their financial situation.
And that makes a lot of sense because, folks have asked me, obviously their number one question is always, what's the real estate market doing? And I know, and Halika and I specifically have had an increase, just like what you said, in listings. We're taking on 4 listings this month. We've already taken 2, and we expect 2 more by the month end. So, on our side, as far as, business as usual, right? As far as taking on listings and right, exactly. As usual, like as it can be, right? We're still utilizing all the different video conferencing and all that good stuff. But as far as being a slowdown, we have not experienced a slowdown in the market. If anything, I feel like people who had been previously waiting maybe for the springtime to list, they're actually doing it now because they realize a lot of people are wanting to buy. They are wanting to take advantage of the interest rates. Now, with that said, I think that that's a great segue into, what restrictions have changed, meaning as far as, the credit scores and things like that, specifically to those government programs like the FHA, VA loans, because lenders are looking at, okay, what is the longevity, right? They're always going to be looking at the risk factor. And they're, in this case, just like you showed, Wade, being that so many are unemployed right now, and especially a lot of the service industry, because things are closed, what does that mean for somebody who is looking to buy? Who is a good candidate, in other words, should be looking to buy versus somebody who should be looking at, let's get our feet wet and start the process, but realistically, when should they be looking?
That's a great question. So the reality is, and I just want to make sure I'm very clear here, the guidelines from Freddie Mac, Fannie Mae, and Ginnie Mae have not really changed. Okay? What's changed is the lenders out there putting overlays on top of what the minimum underwriting standards are. So the government loans specifically, VA, FHA, and USDA. So USDA is for rural property. It's 100% loan to value. I don't specialize in that type of loan, but it's a very good loan program for a lot of people, okay? VA is for veterans or surviving spouses. I do specialize in that. I'm actually an instructor for Military Mortgage Boot Camp, and that is my passion to help veterans. I've got my little flag wall art there, but VA loans are fantastic, the best loan program in the country. FHA is for people with typically lower down payments and less than perfect credit, and all 3 of those loan programs, honestly, are really struggling right now because it's not that the national guidelines have tightened up; it's that each individual lender has raised their credit minimums for the most part. I'm not aware of anyone that hasn't made any changes to their government program. I'm sure that exists because there are dozens and hundreds of lenders out there. But the reality is almost everyone has made some type of changes. It's to mitigate the risk that they're going to be stuck holding a loan that they cannot sell in the secondary market. All right. So it's not that there's anything wrong with these loans all of a sudden. It's that there's not a market after closing for them to be delivered. Therefore, lenders are just not doing them, or they're really restricting the credit box that you have to be in. Now, for some reason, it's only the Ginnie Mae type stuff, the FHA loans, the VA loans, and the USDA loans that are tightening up. The conventional mortgages backed by Freddie Mac and Fannie Mae, so far I'm not hearing of any lenders tightening that credit box. So that tells me that those loans are viewed as safer in the secondary market, which is sad because I think the VA loan in particular is getting thrown out with the bathwater there because of its association with FHA, because they're pooled in the same bucket, which is sad. But that's just the way it is at this point. So we're kind of playing with the hand that we're dealt. So I've seen a lot of lenders raise their minimums, 620, 640, 660, and 680 is the highest that I've heard so far for the government loans, FHA, VA, USDA. But there are still other lenders that will allow for sub 620. Those are few and far between, but they exist. The risk there, though, is that you get halfway through the process with one of those lenders and they change their guidelines on you and you're not grandfathered in. Like I'm hearing that happening left and right, where just because you're approved in the beginning, you could get all the way to the end and they could change their guidelines. And it's not that they're being jerks or that they just don't want to do it. It's that they literally do not have a way to deliver that loan to an investor, and they can't. Lenders are not set up to portfolio loans. If you got to ask a lender to take, $300,000 of cash off their balance sheet to close one single loan, how many employees is that they can't hire? And you do that just a handful of times, you're literally insolvent overnight. So it is not in a lender's best interest to close loans that they cannot deliver. And right now, with things being so volatile, it's getting changes in the middle of a process, and so you just have to kind of navigate it. So some of the things I'm seeing outside of credit score tightening up is self-employed borrowers are getting squeezed by some lenders. This is not across the board, but it's what I'm seeing with some. If you're self-employed, certain lenders are automatically giving you a 25% haircut on your income. Okay. So, but others are not. So it just kind of depends who you're dealing with. So if you're self-employed and you're going through a pre-approval or you're already pre-approved, I would recommend that you ask your lender, hey, does this affect me? Am I still approved? All right. If you've got rental income that you're trying to use to help you qualify to offset debt, certain lenders, again, not across the board, but certain lenders are not allowing rental income to be used to offset the mortgage debt on those properties. So it's an example of you being able to earn income in the real life, in the real world, but what a lender will use is different numbers. So that's why it's important. I had literally a file that I had pre-approved, and then the lender changed their guideline and they suddenly weren't pre-approved. So I had to go find a different lender that would still allow rental income to be used to offset the mortgage payment. So it's those types of things that are changing. So if you're a plain vanilla borrower, you have your own down payment, you've got good credit, and you're in the Freddie Mac, Fannie Mae box, you're good. It's going to be a more aggravating process than you probably want, but you're going to be good. If you've got less than perfect credit, limited funds and or reserves, you're self-employed, you're trying to do anything with the risk premium like a cash out refinance or an investment property purchase, anything outside of the vanilla box, it's going to be harder to get a loan done these days. Not impossible, it's just harder. So some of the casualties of the market so far, the non-QM space, so QM stands for qualified mortgage. It's essentially any loan that doesn't meet the Freddie Mac, Fannie Mae, FHA, VA, USDA standards. So that's the box that the government says you have to fit in. If you're outside of that box, you're typically a non-QM loan. All right. That market was like bank statement programs and like basically the non-prime type stuff. That evaporated in less than a 2-week time period in March. The next thing that tightened up was the jumbo space. So if you're in the market for a larger home and you need a large loan amount, if the loan amount is going to be over $510,400, so $510,400, that's the threshold here in Texas. Anything above that's going to be a jumbo loan. And that money dried up very quickly as well. It's still available, and it kills me to say this out loud, but typically you're only going to be finding that type of financing with a deposit institution, usually on the larger side. So think big banks, bigger credit unions. They're going to be your best sources of financing for jumbo money right now. And man, does that hurt to say that out loud, but it is true. So the next thing that's tightened up, like I've already said, is the government loans. I'm hopeful that is temporary, but I think we're looking at least several months of that. Those loans have performed very, very well over time, especially VA. But again, it's just kind of guilty by association, and it's going to take some time for the economic reality that we're in to kind of flush through the system.
Sure. So that makes a lot of sense. Then I just want to kind of recap, if we can, Wade, a little bit of what you said, because it's great information, and I know that a lot of our professionals that are watching, they're going to definitely get a lot from that. But our residents, our homeowners, our investors who are looking at this and saying, okay, what does that mean for me? So in other words, what Wade is saying is the underwriting process. During the loan, you maybe get a pre-approval letter from a lender that is kind of just surface. It's surface level stuff. How much do you make? What's your credit score? Are you working, not working kind of thing, right? After that process, they go into an underwriter, and that underwriter has different guidelines. Depending on who that lender is, those guidelines can change. And so it's not one specific guideline for every lender. And so that's what Wade is explaining, is that depending on that specific lender, you may or may not have new guidelines that literally can happen overnight.
Right.
And if you're not prepared for that, it could be a really big hit, especially if you're in the process of a transaction right now. So we just want to make you aware, like he said, the good news is that it's not every lender, right? And just because, we're just trying to be helpful here. We certainly want you to do everything you can to work with the lender that you're working with now. But if it comes down to it, ask that lender if there's maybe somebody else that they work with, right? Because I know Wade's been really helpful in the past. If he can't do something, he's really honest with us, and he'll tell Angelica and I, I can't do this, or whatnot, and he'll give us a referral to somebody who potentially could help. So if you have a really good loan person like Wade, they'll be truthful with you and let you know what's coming down the pipeline, so that you can at least save your deal if you are a professional in the business. If you're somebody who's looking right now to see what your options are, like Wade said, there are still people out there doing it. So don't give up just because maybe one lender can't do it. Doesn't mean there's not other lenders who can, right? Especially if you're in a position to refinance, don't give up on the first lender who may or may not tell you yes or no. Because refinancing, it sounds like, potentially could be a better option than doing a forbearance, or doing, some one of these other options where you're going to have to come up with potentially a lump sum at the end, right?
It's not entirely clear, and they haven't provided guidance yet. But if you go through a forbearance, there's chatter, and it's only chatter, that you're not going to be eligible for a refinance until after you have 12 months of on-time payments. So taking that option could, I don't know this for a fact, but it could impact your ability to refinance. And I think during the second and third quarters of this year, frankly, we're going to see the lowest rates of our lifetime. So rates are good now, but with what the Federal Reserve is doing, and once the mortgage industry gets out of the capacity issues that resulted from the record apps that came in early March, that's going to weed out, over April and May. We'll be past that. And that's when a lot of that stimulus stuff that the government's doing should kick in, and I'm expecting rates to be lower. I can't, of course, know that. If I did, I would be a hedge fund billionaire and not a mortgage loan officer. But the reality is that that's what's expected. So I've got a lot of clients right now getting their ducks in a row. So we're putting together proposals for them. We are working through the pre-approval piece of this, and then getting the file set up with the investor so that when rates are at a position where they can benefit, we can pull the trigger. So whoever you're working with, a good loan officer will show you what yes looks like and lay out kind of a roadmap for you to follow. And as far as a refinance is concerned, and I'll just throw out some general information here. If you have an interest rate over 4% for a 30-year fixed, you should probably have a conversation with the lender. I would obviously be honored if it was me. But what I'm going to ask you to do, if you are interested in looking at actual numbers, so remember, anyone that can just tell you an interest rate, but a rate out of context of fees can be misleading. So I would encourage you to get an actual written proposal. And if you want to see what that looks like, just go to mortgageplanningquestionnaire.com. Again, mortgageplanningquestionnaire.com. There's a refinance questionnaire on there. And if you complete that for me as accurately as possible, I'll be able to put some numbers together for you so you can see exactly what it must look like, the rate, the fees, the monthly payment. It's not an application. We're not pulling credit. It's just us doing our due diligence to see if it even makes sense to take that next step. But a lot of people have already low rates that can't benefit, but some people do, and they just need to have rates fall to a certain level. And other people, it's a slam dunk right now, and they should do it now. So it just kind of depends on what your personal situation is. But refinancing to free up several $100s of cash flow in this type of environment, if you can qualify, is probably a good decision, as long as you're going to continue to own the home for the next 2 to 3 years. That's the key. Don't waste your home equity or your money if you're only going to be in the home another year or two. It needs to be longer than that.
That's right.
So.
Yes, and that's a great point, Wade, because a lot of folks say, oh, the interest rates dropped, I'm going to save a 1/10 of a point or something like that.
No.
And, what you have to look at, like Wade said, is, what is the cost of that? Because there's going to be a cost, to refinance.
Thousands of dollars.
Yes.
It's a lot of money.
Mm-hmm.
And veterans are the most susceptible to this because they are targeted heavily by advertisers talking about VA interest rate reduction refinances and all kinds of stuff. The VA has really tightened down on the rules for what a veteran can do to protect them from unscrupulous lenders. So there's got to be net tangible benefits. You got to recoup the fees within a certain time period. I literally had a conversation with a veteran last week where a lender was trying to pressure him into signing documents, and it was like $60 lower of a monthly payment, but it was costing him like $12,000.
Oh my God!
It's just like please don't do that. Even if you wanted to do that, you're not allowed to do that. Literally, the file will get to the underwriter and they will deny it because it doesn't meet the net tangible benefit guideline. So just be careful. This is your home equity out there, homeowners. Use it wisely. I get a lot of questions about, hey, should I pay my closing costs out of pocket? Not usually is the answer that I would give. It kind of depends on where the appraisal comes back at and if there's certain thresholds that we're trying to meet. But by and large, your monthly payment is only negligibly higher by rolling in the closing cost of a refinance. But most people would like the several $1,000s that they would have spent on that. They want to keep that in their pocket, and they're okay with a monthly payment that's maybe $40 higher a month. And so they can keep their whatever, $5 or $6 grand. It just kind of depends on if there's escrow accounts involved and things of that nature. But by and large, rolling in the closing cost is the way to go, with a few notable exceptions.
Okay, that makes a lot of sense. And I would say that we get that question, as you know, Angelica and I work with investors, especially investors at this very moment, looking for that equity, right? And so that's important to tie in all of these things. The best advice we always give is get it in writing, whether it be from us or from Wade, anybody that says they can help you. If they can't prove it by giving it to you in writing, the chances are they're not going to really be able to live up to that standard. So always get it in writing. and compare. We encourage, compare. We tell people all the time, interview us, right, for this position of being your professional, but you should be interviewing at least one other person. This is a lot of times a matter, like Wade said, thousands of dollars, sometimes $12,000, that you're adding to your mortgage if you refinance, and you come to find out later that, that $40 that you were saving a month, it's going to take you 10 years to recuperate. It just doesn't make sense financially. So if you need help in reading those things, we're more than happy to help you at Texas Homeowners Helpline. And of course, Winning with Wade. He always likes for you to win, whether that be with him or anybody else, because I know that he is definitely here to help people. And that's why we like having him on iConnect Texas today. So I'm going to see if, Angelica, do you have any questions that we maybe didn't cover, or any questions that have come in over our question and answers here?
I don't have any questions at this time from anyone. I can check the other one, but
okay.
No, just thank you, Wade, for all those golden nuggets. I mean, that's great for our clients and the people who are on with this as well. So we appreciate
the key is to just find someone that you trust, get it in writing, and have a conversation with a second opinion, because I'm not the right fit for everyone, nor do I want to be. But the people that are looking to, build wealth and memories with real estate, that's why they will choose the three of us, and we'll help them. They'll be more successful with their retirement with us than without us. That's what it comes down to.
Yeah, absolutely. That's a really good point. We always, when we do our buyer seminars, we always like to remind people, yes, this is, if they're going to live in the home, yes, this is going to be the home that you live in, but it's a legacy that you're building for your family. So we want to make sure to help you look at this and put your business hat on, right? And looking at this as an investment, how do you save some money? And also, not to be taken advantage of, because there's a lot of people out there right now that are offering help to do mortgage relief. Don't pay. There's no reason to be paying anybody to help you fill out any paperwork or anything like that. If anybody asks you for any upfront money, please run. Do not do that. Okay, there's a lot of professionals out there that will help you. None of us here are attorneys, so we can't give legal advice, of course, but we can help you at least navigate some of the terms that we talked about here today. Who the servicer is, how to find who owns your mortgage. Actually, let me go ahead and share that really quickly, because I know that this is a resource not only for our homeowners, but also the professionals that may be watching here. If your client asks you, am I a Fannie Mae or Freddie Mac loan, because there are specific programs for that. And one of the ways that you can go ahead and find out, I'm going to go ahead and share my screen here, and so that you can go there. But the National Association of Realtors has actually put out a wonderful resource. And here's that site. And if you go to nar.realtor /coronavirus resources for property owners, you'll find this page here. And it has a lot of great links, as you can see, talking about, the FDICs, different of the big banks, and where to go and get information about them. It talks about just different government agencies and things like that, and it has that link. And then down here at the bottom, it does have that Fannie Mae, Freddie Mac link that you can go to as well. It has the links directly to the IRS pages, Small Business Administration, the VA loans, just like Wade was talking here. And so this is a wonderful resources. Of course, go to those trusted resources. There's links out there for different media sites and things like that. Be careful what you share online, especially if you're a professional. We want to make sure that we're sharing qualified information from actual resources. So another place that you can go ahead and go is the Freddie Mac site. And it also talks about providing assistance to borrowers. And you can just click on a couple of different things there as well. And with that, it does have My Home by Freddie Mac has a site that you can also go to that'll give you at the bottom here, it says, find out if Freddie Mac owns your mortgage. And you can actually go to loan lookup. And so this is a tool that we've used before. I actually was in real estate during the '08 and mortgage crisis, and we did help a lot of families who qualified through the Freddie Mac assistance. And so this would be a way to find out whether they own your loan or not, because as we mentioned before, just because it's serviced by somebody doesn't mean that that it's they're the ones who actually are the investors in the loan. So just a couple resources for our professionals and also the public out there. Wade, I think one other quick question that I have is, how do we get in contact with you? Obviously, there are other lenders out there, but we like to encourage folks to connect with you. And I know Winning with Wade is how I remember you.
Exactly.
So yeah, share with us really quickly, how do we connect with you?
So my website is winningwithwade.com, and I've got a lot of good content on there. I'm actually a big fan of videos, so most of my content is educational video information. But as far as email address, it would be the Betz team. So Betz is spelled B as in boy, E-T-Z as in zebra. So the Betz team at winningwithwade.com. And then my direct line, 469-925-0374. Again, 469-925-0374. That is my direct line. You can call or text me there. If you do call and I'm not able to answer, though, it does roll over to a receptionist because I want to make sure that every call gets answered. So just leave me a message. I'll call you back as soon as I possibly can, and look forward to taking great care of you. I'd be honored to take great care of you.
Thank you so much, Wade. And we did have a little note here to you from Gloria Gonzalez Garcia. She says, thank you for the abundance of information. So she enjoyed it.
Thank you.
So thank you, Gloria, for watching. And I hope that this has been helpful for you. We will be doing some more updates because, like Wade said, the market is changing sometimes daily.
Yeah.
And so we will be hopefully doing another update in a couple of weeks when we're all out of quarantine. And hopefully we can do a face-to-face, but if not, we are happy to do this online, and so that you all stay safe. And thank you again, Angelica, for joining us from Texas Homeowners Helpline. And we just wanted to encourage you to stay connected. Go ahead and visit your local small businesses. And please help each other, stay safe, and stay home, stay well. Talk to you all soon. Bye-bye.
Bye.